What's the relationship between interest rates and the stock market? The common view I've heard on CNBC is the market goes up as rates go down, and the market goes down as rates go up. But since the early 90s, this just is not correct. In fact, it's closer to the opposite. Since rates bottomed in the early to mid 90s, the most common scenarios are as rates went up, the market went up, as the Fed tried to slow down the economy. And as rates went down, the market went down, as the Fed tried to stimulate the economy. The strongest correlation was if rates were steady, the market did really well. The economy was humming along with minimal Fed intervention, and it was easy for corporations to plan with a predictable rate. Let's look at some charts illustrating this. The chart annotations will be a little subjective, with some cherry picking of time ranges. There's many ways you could slice and dice these charts, but it's hard to argue with the first chart. Here I've highlighted the areas in the chart with fairly constant rates. Steady rates equals a bull market. Flat rate, the red line goes up. Flat rate, red line goes way up. Flat rate, red line goes up. Long flat rate, extended bull market. And then right after the pandemic, we had a nice steady rate for about a year, and the market just shot through the roof. The one exception was back here. It really wasn't an exception. This was the 1987 crash. And the rates were relatively flat, but the market actually still went up over that time period. Next up is the chart highlighting the positive correlation time periods. This is out of sync with what you normally hear from the financial news. Rates up, market up. Rates down, market down. These times are at least as common and probably more so than the inverse. From the start of 2016 over here to the middle of 2018, there was 2.5 years of rising rates and a rising S&P. At the end of the 90s over here, all the way until the rates bottomed at the end of the financial crisis, at the end of 2008, there were 4 periods of positive correlation, both up and down, up, down, up, down. And the 80s also had a couple periods of positive correlation. However, the most interesting correlation is the inverse, which has been rare since the early 90s and is what we're experiencing now. Green highlights are times when the S&P has gone up while rates have gone down. This happened for a long stretch in the mid-80s, right here, and an even longer time from the late 80s to the early 90s, here, but has only happened recently, just before the pandemic, right there. Red highlights are when the S&P has gone down while rates have gone up. This happened in the mid-80s, right before an extended bull run, right there, and for a short time in the mid-90s, also right before a significant bull run, right there. But more recently it happened right after the peak of the dot-com crash, right there, right at the start of an extended bear market, and at the start of the financial crisis when rates briefly bounced up, right there, in the midst of a bear market that quickly got much worse. It just happened again in a bigger and more noticeable way than ever before. We haven't seen a rate hike with this velocity in the last 43 years, and rate rising periods accompanied by a falling stock market have been rare. So we're in a pretty unique situation, uncharted territory. Is this going to be more like the 80s and mid-90s with a bull market coming? Or the dot-com and financial crisis with a painful extended bear market? It's definitely worrisome, but difficult to know. Again, we've never seen the rates rise this fast while in a bear market and while the economy runs hot. At least nothing close to this has happened going back to 1980. It's just one indicator, so don't get too bent about it. But you might want to be a little extra careful over the next year or two. And finally, I'm not a financial advisor. This isn't financial advice. It's just a look back at the historical relationship between rates and the market. If you found this interesting, please like and subscribe.